Good morning. Call to order this hearing of the Minnesota Senate Taxes Committee, Wednesday, May 7th. It is 8:40 a.m. First item, quorum is present. First item on our agenda is adoption of the minutes from May 6, 2025. Are there corrections or additions to the minutes? Seeing none, the minutes are approved as presented. Our business today is to review, and Senate Council will be doing that for us article by article. The chair's mark on 2374. It is a Senate file currently, the governor's tax bill. When the House passes its bill and it comes over, then we adopt that House file number. But until then, we are dealing with the Senate file 2374. So we will begin with Senate Council presenting the bill, and then we will go to testimony, only testimony in opposition. Yes, I'm going to ask you in just a second. Testimony in opposition, but while we're going through the bill, members will have the chance to talk with the with Senate Council. So we also are going to hear from Commissioner Marquardt. Commissioner, did you want to speak first, or did you want to wait until after we present the bill? Afterwards? Okay. So I'm going to ask Senate Council to go to the witness table for the presentation. The articles in general represent some bills that are familiar to the members of the committee, and we don't need a deed of those, like the LST or the helium article or whatever. We don't need detailed presentation of ones that we're familiar with. Ms. Pollack, would you like to begin?
Madam Chair, would you like us to go through the articles first, or would you like Mr. Mumm to go through the spreadsheet first?
Thank you. I always forget that. The spreadsheet guides us in going through the language, so let's begin with the spreadsheet.
Okay. Madam Chair and members, the spreadsheet in your packet should be titled 2025 Omnibus Taxes Bill, Senate File 2374, Delete Everything Amendment. It's 8 pages, so that is what I will go through. The first 2 lines just summarize the overall effects, fiscal effects of the bill. I will focus on the last, the rightmost column here, which shows the the fiscal effect for the next 4 years. So there's a net increase in tax revenues of $625.58 million and a net change in property tax aids and credits expenditures of negative $109.42 million for a combined effect of a combined savings to the general fund of $735 million. The income provisions are next on page 1. Line 10 shows a net investment income tax increase. The rate is being increased from 1% to 1.5%. This was first enacted in 2023, and this rate change would increase revenue by $144.5 million. On line 11 is a provision that was carried in the governor's budget, increasing imposing a penalty for landlords that fail to submit a certificate of rent paid. It's expected to raise $120,000. Line 12 is from Senator Klein's bill providing a subtraction for foreign service worker pay. The next two lines are part of Senator Gustafson's bill that provides a subtraction for discharged coerced debt and also modifies the definition of income for calculating the renter's credit to exclude those payments. These both have a negligible effect on revenue. Similarly, the next lines 15 and 16 provide the same treatment to payments received from the Consumer Enforcement Compensation Account payments. This is part of Senator Rest's bill creating the Consumer Protection Account. On line 17 are modifications to the political contribution refund, estimated to have a negligible effect on revenues. On line 18 are modifications to the assignability of the education credit. It's estimated to have an unknown savings to the general fund. On line 19 is Senator Umu Verbatim's provision regarding Section 530 in worker misclassification. On line 20 is a modification, Senator Rest's provision modifying the pass-through entity tax credit, extending it through tax year 27. And on line 21 is a subtraction for student loan reimbursement payments for critical access, employees of critical access dental clinics. All of the preceding provisions have either a negligible or unknown effect on revenue. Similarly, the short line railroad infrastructure.
Mr. Munn, I have a different line number. For example, for line 20, I have the Umu verbatim bill. Could you explain the difference, please?
Yeah, Madam Chair, what is the title of the spreadsheet that you have?
The one I have is taxes bills comparison.
Yes, I'm walking through the spreadsheet that's titled 2025 Omnibus Bill, which just has the change items in the Senate bill. The other spreadsheet shows a comparison to the governor's budget, so it's a little more detailed.
Yeah, we'll get to that.
Okay.
Excuse me. Thank you very much for the clarification.
When you're ready for me to proceed, okay. On line 21, or on 22 is Senator Weber's provision modifying the transferability of the short line railroad credit. I failed to point out that in the leftmost column with the Senate file and author, if this provision was carried in Senate file 132, which is the early omnibus bill that the committee passed, that is notated here. On line 23 is a provision from Senator Rest that corrects a annuity contribution calculation. It has no fiscal effect. On line 24 are modifications to the e-bike rebate with that also has no fiscal effect. Line 25 is Senator Dornick's provision that modifies the education credit to include CTE expenses. It's estimated to cost $7.6 million. Line 26 is Senator Johnson Stewart's modification to the education or to the credit for receiving a master's degree to include special education. That has a cost of $6.1 million. Line 27 are modifications to the historic rehabilitation credit, estimated to cost $1 million. On line 28 is Senator Kupek's subtraction for National Guard members that are serving in neighboring states to Minnesota. On line 29 and 29, 30, and 31 are modifications to the beginning farmer credit. Line 29 shows the effect of removing the cap, which is carried in Senator Putnam's Senate File 1419. There are additional modifications to the eligibility of the beginning farmer credit, and coupled with removing the cap, that creates an additional cost that's shown on line 31. The remaining lines are all interactions with provisions that are in the property taxes section or the local government aid section of the bill, related mostly to the deduction for property taxes. Moving on to the second page, line 41 shows a change to the net operating loss deduction. It's reducing the limit from 70% to 60%. You'll recall that this was modified in the 2023 Omnibus bill from 80% to 70%. That's expected to increase revenue by $92.6 million. On line 42 is a modification to the film production credit. It decreases the allocation to $1 million per year. That results in a savings of $8.6 million across the next 4 years. On line 43 is Senator Rest's provision for sustainable aviation fuel. This is the same provision that's carried in the governor's bill. I will point out that Senator Rest also had a bill, Senate File 1312, that was heard by the committee and amended to match the governor's language. And on line 44 is just another appearance of the short line railroad credit transferability, showing no fiscal effect. Lines 48 through 50 are all unknown interactions with the estate tax related to modifications to the eligibility of agricultural homestead property. And on line, beginning on line 53 are changes to sales and use tax. There is an exemption for the PGA golf tournament events that is expected to have a cost of $1.83 million over the next 4 years. On line 54 is an exemption for admissions to intercollegiate sports events. That has expected to have a cost of $11.85 million. On line 55 is an exemption for construction materials for the Browerville School District, expected to cost $490,000. On line 56 is a exemption for the Woodbury Water Treatment Facility that is expected to cost $1.11 million. And on line 57 is a clarification of an exemption that was enacted in 2023 for the city of Ramsey that is not expected to change the cost of the exemption. On line 58 is a provision that extends the sunset for the data centers exemption to the year 2062. There's an asterisk there notating that any fiscal effect is outside of the budget horizon. And on line 59 is a one-time June accelerated sales tax remittance of 10.896% in 2027. This has the effect of recognizing $44.4 million of revenue in fiscal year 27 instead of in fiscal year 28. So the net cost across the two biennia is zero. On line 63 is a provision from the governor's bill that repeals local government cannabis aid. This is 20% of the cannabis gross receipts tax revenue. It would be deposited in the general fund rather than being spent on the local government, on the aid program, which would create general fund revenue of $64.6 million. On line 66 is a new excise tax on social media companies. That was in Senator Rest's Senate File 3197 that the committee heard. It is expected to generate revenue of $334.3 million. On line 69 is Senator Umu Verbaten's repeal of the tax on illegal controlled substances. Moving on to page 3, these are the property tax aids and credits changes in the bill. On lines 77 and 78 are companion provisions to the subtraction for discharged and course debt and payments from the consumer protection account. This just removes those payments from the calculation of income for the renters, or I'm sorry, for the homestead property tax refund, expected to have a negligible or no cost. On line 79 is the attachments and appurtenances clarification. These are all interactions with property tax refunds that largely result from shifts onto property tax shifts onto homesteads that change the amount of property tax refunds. On line 80 is a modification to homestead resort property that increases property tax refunds by $80,000. On line 81 is an interaction with the shareholder limit increase for ag homestead classification. Line 82 is an exemption for properties used by nonprofits for grazing. On line 83 is another modification to the agricultural homestead classification, expanding eligibility of qualifying relatives. On line 84, lines 84 through 86 are exemptions for tribal-owned property that have one of them has a $20,000 effect. The other two have negligible effects on property tax refunds. On line 87 is the governor's provision for, in response to the Alliance case that creates an exemption for low-income housing tenants. That's expected to increase property tax refunds by $130,000. On line 88 is the effect of a land bank property tax abatement provision, increasing refunds by $40,000. Lines 89 and 90 are provisions that modify the market value exclusion for disabled veteran homesteads. Line 89 is the effect on veteran-owned homesteads, and line 90 is the effect on other homesteads that would see property tax refunds. Refunds would increase for those homesteads. On line 91 is an exemption for airport hangars used for manufacturing. And the other lines 92 through 95, I'm sorry, lines 92 and 93 are interactions with two aid programs that I will describe later. Line 94 is an exemption for property owned by the Bloomington Port Authority. Line 95 is a modification to agricultural property classification related to market farming and floriculture. Has a negligible effect on property tax refunds. Line 96 is a change from Senator Rasmussen's bill that modifies the residency requirement for qualifying for ag homestead property. Line 97 is a valuation reduction for conservation easements. It's an allowance for that reduction. Lines 98 line 98 deals with Class 2C forest land, and line 99 is a property tax exemption for an electric generation facility. This has no cost in the next two biennia, but is expected to increase property tax refunds beginning in fiscal year 30 after the plant comes online. And lines 100 and 101 are property tax refund interactions with the changes to local government aid and county program aid that I will describe on the following page. On page 4, these are the changes to local government aids. Lines 104 and 105 are the reductions to local government aid and county program aid. They are each reduced by $20 million a year, beginning with aids payable in 2026. On line 107 is an increase to Soil and Water Conservation District aid. This was from a bill carried by Senator Hochschild. The amounts are slightly different than what was contained in that bill. On line 108 is the establishment of a fire protection and emergency medical services aid program. It is funded at $1.555 million, beginning with aids payable in 2026. Line 109 is a provision from Senator Hochschild establishing a school seasonal tax-based replacement aid program. This would be funded with $3.4 million, beginning with aids payable in 2026, and has a total cost of just over $11 million. Lines 110 through 113 deal with aid penalty forgiveness for 4 cities, Stewart, Alpha, Odin, and Trotsky. The first two forgive 2023 local government aid payments, and because that fiscal year appropriation has closed, there would be a new appropriation to make payments to those cities. For the cities of Odin and Trotsky, the appropriation authority still exists, and there would not need to be a new appropriation, which is why there's no cost for those provisions. Line 114 shows the imposition of a reporting requirement for recipients of public safety aid enacted in the 2023 taxes omnibus. Line 115 is a modification to township aid that has no cost, but allows the entirety of the township aid appropriation to be utilized. Line 16 is a provision from Senator Farnsworth that creates a sparsity adjustment within the local government aid formula. And on line 117 is the sunset repeal for local homeless prevention aid. This is currently set to expire in 2028. And extending the sunset has no effect within the next 4 years, but would impose a cost beginning in fiscal year 30. Lines 121 through 124 show interactions with the ag homestead market value credit related to property tax provisions that have already been discussed. Similarly, on lines 120 and 127 and 128 are interactions with the school building bond agricultural credit. All of those effects are either unknown or negligible. On line 132 is a reduction to sustainable forest incentive payments. The governor carried this provision but reduced SFIA payments by 30%. The figures here comport with a 10% reduction to SFIA payments, which saves about $5.52 million. On line 133 is a provision from Senator Drazkowski establishing an agricultural water quality credit expected to cost $3.46 million. The next provisions all have no fiscal effect, and Mr. Sylvia will discuss them when walking through the articles. On page 5 are several other items, the first few of which have a fiscal effect. There is a one-time transfer of money that's currently in the local government cannabis aid program into the general fund related to the repeal of local government cannabis aid. On line 147 is the cancellation and repeal of the tax modernization account, which was an appropriation in the 2023 omnibus tax bill that has not been expended. Similarly, on line 148 is a $10 million cancellation of an appropriation made in the 2023 omnibus taxes bill for a grant to the city of Minneapolis. On line 149 is an appropriation to the Department of Revenue to establish a new audit division. This was also a provision carried in the governor's bill. The governor's budget recognizes some revenue that would result from creating this new audit unit, but the Senate bill does not calculate that revenue in the totality of the bill. And lastly, on line 150 is a $250,000 grant to the city of South St. Paul for redevelopment. The remaining provisions on this page have no fiscal effect and can be discussed in greater detail when walking through the articles. Similarly, on page 6, these are the tax increment financing provisions that are contained in the bill. None of them have a fiscal effect, and I will move on to page 7. These are the non-general fund changes to the bill. Everything on page 7 is related to the sales tax changes that are in the bill. These are the effects on the legacy funds and the Housing Assistance Fund and Transportation Advancement Account, the latter two of which are supported by the Metro-wide sales tax revenue, and so are impacted by some of the sales tax exemptions that are contained in the bill. I will point out, though, on lines 207 and 217, these are from a provision carried by Senator Draheim that modifies the definition of the metro area subject to the sales tax, and it would have the effect of excluding certain cities from that metro area. This would decrease metro-wide sales tax revenue by $570,000 for the Housing Assistance Fund and $280,000 for the Transportation Advancement Account. And finally, on the last page, on line 222 is a provision from Senator Weber regarding the timing of refunds for pharmacies. This would have no effect on the Healthcare Access Fund. And on line 225, this just shows the money that would be repealed from the tax modernization account. It would be credited to the general fund. Similarly, on line 228, this is money that would not be instead of being in the local government cannabis aid account, it would go into the general fund. And then the last two lines just reflect the establishment of two new funds in the bill, the Consumer Protection Restitution Account and the Helium Property Tax Relief Account. There's not expected to be any fiscal activity within those accounts, but they are on the spreadsheet to note their establishment. And that concludes the walkthrough of the spreadsheet.
Thank you, Mr. Mogg. We'll now go through the language of the bill, article by articles. Ms. Pollack, if you would begin.
Madam Chair, Nora Pollack, nonpartisan counsel to the committee. Mr. Sylvia and Mr. Mumm and I will go through the articles kind of interchangeably if we could have your leave to do that.
Fine.
Article 1 is the income and corporate franchise tax article. Sections 1 and 2 are from Senate File 9, authored by you, Madam Chair, pertaining to the establishing an online system for the political contribution refund. Section 1 allows the Campaign Finance Board to access and use data about the program in the electronic reporting system and to share the data with the Commissioner of Revenue. Section 2 establishes requirements for the Campaign Finance Board's operation of electronic filing of the political contribution refund program. Section 3 comes from Senate File 1428 from Senator Weber and Senate File 1419 from Senator Putnam. And this section modifies some definitions that are used in the beginning farmer credit and the credit for owners of agricultural assets, modifying the definition of beginning farmer to include an LLC owned by an individual or two related individuals, and it establishes a definition of emerging farmer. These provisions are effective beginning in tax year 2025. Sections 4, 5, and 6 are also pertaining to the beginning farmer and credit for owners of agricultural assets credit, and they come from Senator Putnam's Senate File 1419. Section 4 makes some conforming changes for the new term limited land access farmer that I mentioned in Section 3. Section 5 removes allocation limits for the credit for owners of agricultural assets, and Section 6 makes conforming changes for purposes of the report to the legislature on the credit. The sections 4 and 5 are effective beginning in tax year 2025, and section 6 is effective for reports due for credits beginning in tax year 2026. But the change to the report regarding the term limited land access farmers is effective for reports for credits issued beginning in tax year 2027. Section 7 it comes from the chair's mark here for Senate File 2374 and reduces the allocable amount for the film production credit to $1 million a year. And it's effective for allocation certificates issued the day following final enactment and after for taxable years beginning after December 31, 2024. Section 8 comes from this file, Senate File 2374, and the governor's bill, and also appeared in Senate File 132, striking language regarding a tax preparer's authority to assign a portion of the K-12 credit refund to an account without the taxpayer's name. This section is carried along with the repealer of the assignability of the credit in Section 32. These provisions are effective beginning in tax year 2026. Section 9 and Section 17 pertain to the pass-through entity tax. These come from Madam Chair, your bill, Senate File 3405. It extends the expiration of the PTE tax election by 2 years through tax year 2027, and Section 17 extends the credit for the PTE tax paid to another state. Section 10 comes from Senate File 668 from Senator Coupet, expanding the subtraction for National Guard and Reserve compensation to include the compensation paid to Minnesota residents who are members of the National Guard in neighboring states. And this is effective beginning in tax year 2025. Section 7 comes from Senate File 860 from Senator Gustafson and also appeared in Senate File 132. This provides a subtraction for amounts amounts of discharges of indebtedness for coerced debt, and sections 23 and 30 exclude these amounts discharged for purposes of the income for the renter's credit and the property tax refund. Section 12 provides a subtraction for the amount of consumer enforcement public compensation payments received. This comes from Senate File 447, Madam Chair's bill, and sections 20 and 23, which I also mentioned pertaining to the subtraction for discharges of indebtedness. Sections 23 and 30 also exclude the consumer enforcement public compensation payments for purposes of calculating income in the renter's credit and the property tax refund. Sections 11 and 12 are effective beginning in tax year 25 and as is Section 23. And Section 30 pertaining to the property tax refund is effective for taxes payable in 2026 and thereafter. Section 13 comes from Senate File 2293, Senator Weber's bill, to provide a subtraction for the amount of student loan educational assistance payments made by critical access dental clinics on behalf of their employees. This is effective beginning in tax year 2025. Section 14 comes from Senate File 211, Senator Klein's bill, and also appeared in Senate File 132 to provide a subtraction for the amount of foreign service pension or retirement compensation received under specific pension systems. Section 27, later in this article, includes the subtraction for purposes of calculating alternative minimum tax. Section 15 comes from the chair's mark and the delete amendment here, increasing the net investment income tax from 1% to 1.5%, effective beginning in tax year 2025. Section 16 is another provision regarding to the political contribution refund, specifying that the commissioner must not issue a refund exceeding the maximum refund amount and allowing a person to file a refund claim using the electronic filing system. This is effective beginning for contributions made after December 31, 2026. Section 17, I already mentioned regarding the modification to the PTE option. Section 18 is another section pertaining to the beginning farmer incentive credit, coming from Senate File 1419 from Senator Putnam, striking language pertaining to the limitation on the allocation certificate. And this is effective beginning in tax year 2025. Section 19 comes from Senate File 501 from Senator Dornick, expanding the expenses eligible for the K-12 credit to include expenses for a qualifying child participating in a career and technical education program. This is effective beginning in tax year 2025. Sections 20 and 21 come from Senate File 2115, Senator Clark, to modify some provisions in the historic structure rehabilitation credit. In Section 20 increases the length of time by which a project that qualifies for the credit must be placed in service from 3 to 6 years. And this is effective retroactively for projects that had an allocation certificate issued after June 30, 2021. Section 21 allows an assignee to assign the credit in whole to a second assignee before the first assignee's payment is claimed. And this is effective for applications for certificates submitted after June 30, 2025. Section 22 comes from Senate File 249, Senator Johnson Stewart, expanding the credit for attaining a master's degree in a teacher's licensure field to include a master's degree in special education, and also allowing for that program to include a pedagogy or pedagogy component. This is effective beginning in tax year 2025. I already mentioned Section 23 regarding the exclusion of discharge, coerced debt, and consumer enforcement public compensation payments for purposes of calculating the renter's credit. Section 24 comes from Senate File 2374 and the governor's bill requiring an owner or managing agent to furnish a certificate of rent paid to the commissioner for purposes of the renter's credit and imposes a penalty on owners who fail to furnish the certificate to the renter or to the commissioner. And this is effective for rent paid beginning in January 2026. Sections 25 and 26 come from Senator Weber's bill, Senate File 1046, and were also included in Senate File 142. These provisions also appear in the governor's bill, I think with a small modification to the effective date. These add a definition of credit certificate for purposes of the certification and transfer provisions for the short line railroad infrastructure modernization credit. And Section 26 modifies the process by which the credit certificate is issued and the credit transfer occurs. And these provisions are effective retroactively to tax year 2024. Section 28 comes from the chair's mark here, reducing the net operating loss deduction from 70 to 60% of taxable net income, and this is effective beginning in tax year 2025. Section 29 comes from Senate File 210 from Senator Uma Verbaeten, decoupling Minnesota from Section 30 of Public Law 95-600 for purposes of employer withholding tax liabilities for worker classification purposes. I already mentioned Section 30, which excludes certain income for purposes of calculating the property tax refund. Section 31 comes from Madam Chair's bill, Senate File 2580, requiring an annuity contract provider to allow a correction of a contribution amount effective retroactively for notifications for contributions made in 2024 that applied to the previous year's 2023 contribution limitation. Section 32 is also the repealer of K-12 assignability credit modifications, which I mentioned earlier. Madam Chair, that concludes the income and corporate franchise tax article.
Thank you, Ms. Pollack. Mr. Silvio.
Madam Chair, members, Eric Sylvia, nonpartisan counsel. Article 2 is the property tax article. Section 1 contains two bills. The first is Senate File 49 from Senator Weber, and this would provide that exempt property that's owned by a nonprofit conservation organization that is leased, loaned, or otherwise made available to an association or corporation or individual for grazing activities remains exempt. Within this section is also Senate File 1027 from Senator Hochschild that would expand the current law exemption for certain airport property and would also allow a 12-year 50% net tax capacity reduction for certain airport property owned or operated by a city with a population over 50,000 but less than 150,000. Sections 2, 18, and 19 are from Senator Putnam, Senate File 132, and these are the attachment and appurtenances sections. And they clarify that except for substations and transmission or generation equipment, a utility cooperative's power distribution systems are exempt from property taxes. The next several sections are property tax exemptions. Section 3 is from Senator Mohammed's Senate File 1579. This would establish a permanent property tax exemption for property located in Minneapolis and owned by the Leech Lake Band of Ojibwe. Section 4 is from Senator Jasinski, Senate File 2615, and this would establish a personal property tax exemption for the Steel Energy Station, a proposed power plant to be built in Owatonna. Section 5 is from Chair Rest, Senate File 3413. This would establish a permanent property tax exemption for additional property in Minneapolis owned by the Mille Lacs Band of Ojibwe. And Section 6 is from Senator Hochschild's Senate File 364. And this would also establish a permanent property tax exemption for 5 parcels in Cook County that are owned by the Grand Portage Bank of Lake Superior, Chippewa. Section 7 is from Senator Dibble's Senate File 2199, and this would provide that a metropolitan county that has adopted a program to protect farmland or natural areas may, by resolution, authorize their county assessor to consider the impact of a conservation easement on the property's assessed value. Section 8 is from Senator Anderson's Senate File 755, and this would increase from 12 to 18 the number of allowable shareholders, members, or partners for entity-owned agricultural homestead property. Section 9 contains language from 2 separate bills. The first, Senator Weber's Senate File 245, and this would expand the list of qualified relatives required for a special agricultural homestead for purposes of unoccupied agricultural property. This section would also allow property to qualify for this special agricultural homestead if the owner and the person actively farming the agricultural property live within the county where the property is located or lives within a county that is adjacent to the county where the property is located. Section 10 is from Chair Rest Senate File 33, and this relates to the Class 4D1 program, and it clarifies that income average is allowed for Class 4D1 low-income rental property classification. Section 11 is from Senator Hochschild's Senate File 2076, and this section modifies the 3 class rates for Class 1C homestead resort property. There are 3 bills contained within Section 12. The first is from Senator Hochschild's Senate File 1633, and this relates to Class 2C managed forest land. Within this section is the elimination that the property's forest management plan meet all the requirements of the SFIA chapter, the Sustainable Forest Incentive Act chapter. It provides cross-references to the definition of a forest management plan and an approved plan writer. And it also provides that land that is otherwise eligible to be classified as Class 2C is eligible regardless of whether it is wholly or partially subject to a conservation easement. Also within this section are proposals from Senator Drazkowski, Senate File 2626, and Senator Putnam, Senate File 1498. And this would expand the definition of agricultural land by adding floriculture. And this section would also allow property to qualify as agricultural under sort of the market value approach. So if the property consists of contiguous acreage containing a residence and is less than 15 acres, if the contiguous acreage inclusive of the house, garage, and surrounding 1 acre of land was used in the preceding year for market farming, and the owner provides the assessor with Schedule F for the most recent tax year, which reports gross income of at least $20,000. I will note that within that section concerning the market farming and floriculture, some changes were made from when the bill was originally heard in committee. I noted the income required on the Form 1040 is $20,000. The bill, as we heard it, was a $5,000 requirement. And also the original language of the proposal allowed sort of a secondary eligibility for agricultural homestead for future earnings. That has been removed, so it would require the Schedule F showing gross income of at least $20,000 in the most recent tax year. Section 13 is from Senator Chairmark, and this relates to the disabled veterans homestead market value exclusion. This would increase the exclusion amount for those with a disability rating of 70% or more, and those with a 100% total and permanent disability. Sections 14 through 16 and 20 and 21 are from Senator Drazkowski, Senate File 1269, and this authorizes and establishes a property tax credit for agricultural and rural vacant land if the property is located in certain southeastern counties and is certified under the Minnesota Agriculture Water Quality Certification Program. Section 14 establishes the property tax credit. The remaining sections add cross-references to the list of credits that are certified by the Department of Revenue to the Department of Education, the credits used to compute the amount of net taxes owed, and then lastly, the credit would appear on both the notice of proposed property tax and the contents of the tax statement. Section 17 is from Senator Rest, Senate File 2374, and this would allow an exemption for a lease of any term of residential housing property that is exempt from property taxation as an institution of purely public charity. I mentioned Section 20 and 21 are from the Ag Water Quality Credit. Section 22 is from Senator Drazkowski's Senate File 308, and this relates to the interest rate on confessions of judgment for owner-occupied homestead property. This would set that interest rate equal to the prime rate charged by banks, rounded to the nearest full percent, but not lower than 5% and not higher than 14%. Section 23 is from Senator Farnsworth, Senate File 3374, and this would increase from $3,000 to $10,000 the annual limit that a city of the third class may expend for the purposes of providing free musical entertainment for the general public. Sections 24 through 27 are from Senate File 2754 from Senator Kupek, and these relate to the Board of City Development Zones. Section 24 eliminates a restriction that to qualify, a city must designate an area or within an area, area or areas within the city that is at least 100 acres but less than 400 acres. Sections 25 and 26 allow allocations and additional allocations to be used on certain types of recreation or entertainment facilities. And Section 27 provides that the cities of Dilworth, Moorhead, and Ortonville may designate all or any part of its city as a development zone. I will note that when the bill was originally heard in committee, there were two additional sections within this proposal, one being an increase to the annual appropriation and one being an increase to the income tax credit. Those two sections are not contained within this delete everything amendment. Sections 28 through sections 30 from Senator Rest, Senate File 51, concerning land bank abatements. Section 28 defines the land bank organization. Section 29 authorizes political subdivisions to grant a property tax abatement. Section 30 sets the duration limit of that abatement. And Section 31 provides a repayment or clawback mechanism if the land for which the abatement was granted is used for a purpose other than the purpose given by the organization prior to the development. Section 32 is from Senator Wickland, Senate File 1587, and this would extend by 6 years a property tax exemption for 3 parcels owned by the Port Authority of the City of Bloomington. And lastly, Madam Chair, members, Senate 33 is from Senator Hochschild's proposal, and this would repeal 2 sections which require a fiscal disparities adjustment on the TNT notice of proposed property taxes and the property tax statement. And Madam Chair, that concludes Article 2, property taxes.
Senator, Ms. Pollack.
Madam Chair and members, Article 3 is the sales, excise, gross receipts, and local sales tax article. Sections 1 and 2 require vendors to remit 10.896% of their estimated June liability before June 30, 2027, and it's effective for that year only. Section 2 adds a reference to that amount, the 10.896%, for purposes of application of penalties for underpayment. And I should mention, Madam Chair, those provisions come from your chair's mark here. Section 3 comes from Senate File 2815 from Senator Weber, allowing pharmacies to claim a refund on a quarterly basis of the amount paid for to wholesale drug distributors for legend drug delivered by the pharmacy outside of the state. Section 4 comes from Senate File 3197 from Chair Restbill, imposing a tax on the collection of consumer data by social media platform businesses based on the number of Minnesota consumers from whom a social media platform business collects data in a month. And this is effective beginning in January 2026. Section 5 comes from Chair Rest Senate File 3237, establishing a tax exemption for admissions to PGA events and related PGA-sponsored events. Section 6 comes from Senate File 769 from Senator Hauschild, or I should say it's based in part on that, extending the sunset date for the data center's sales tax exemption to the earlier of 20 years after the date of the first qualifying purchase, or June 30, 2062. Section 7 comes from Senate File 2336, Chair Restbill, to exempt tickets and admissions to games and events for intercollegiate sport events sponsored by public institutions of higher education. Section 8 comes from the chair's mark here, extending the moratorium on local governments taking any action to impose a new local sales tax or modify an existing local sales tax. And this section is effective only if the provisions of Article 5, the local sales tax reform article, are not enacted in this session or a special session ending before July 1 of this year. Sections 9, 10, and 11 come from Senate File 765 from Senator Draheim, applying a statutory definition of metropolitan area for purposes of the regional transportation sales tax and the metropolitan area sales tax. And these are effective beginning in July 1 of 2025. Sections 12 and 13 come from Senate File 3017 from Senator Hauschild, modifying the Hermantown local sales tax, allowing the sales tax to be used to fund multiple sewer interception line and multiple booster pump station projects. Section 13 extends the expiration date of the tax to the earlier of 10 years or December 31, 2046. Extends the expiration date by 10 years to the earlier of December 31, 2036, or when the city determines sufficient funds have been paid to pay the bonds for the projects. These sections are effective without local approval. Section 14 comes from Senate File 1981 from Senator Barr, modifying the construction exemption for materials for the city of Ramsey to include materials for trunk water main improvements. Section 15 comes from Senate File 5, Senator Utke, providing a sales tax exemption for construction materials used for the Browerville pre-K through 12 school building and associated facilities. Section 16 comes from Senate File 13, Senator Mitchell, providing a sales tax exemption for construction materials used for a water treatment facility and water tower and water pipeline infrastructure and associated improvements that are funded by the city. Section 17 comes from Senate File 209, Senator Umu Rubaten, repealing the illegal cannabis and controlled substances tax chapter. Madam Chair, that concludes Article 3.
Thank you, Mr. Sylvian.
Madam Chair, Casey Mum, Senate Fiscal Analyst. I'll be going through Article 4, which is the Property Tax Aids article. Sections 1, 2, and 14 are from Senator Hauschild's Senate File 1197, which establishes a school district seasonal tax base replacement aid program. Section 1 makes a conforming change to the general education aid formula, reflecting the establishment of the aid. Section 2 establishes the aid, and it offsets voter-approved operating referendum levies in districts with Class 4C12 seasonal recreation property. It would reduce voter-approved school district referendum rates by up to 50% in school districts with large amounts of Class 4C12 property. And it'd be effective for taxes payable in 2026 and later. Section 14 makes an appropriation through the general education aid formula of $3.422 million. I will note that this would be subject to the inflation adjustment, even though the Senate's education bill repeals the basic allowance education inflation adjustment, because this would be a voter-approved operating referendum levy. Sections 3 and 4 relate to Senate File 128 from Senator Farnsworth. It provides for a local government aid sparsity adjustment within the local government aid formula. Section 3 makes a conforming change to the calculation of a city's revenue need. And Section 4 establishes the sparsity adjustment within the formula. The adjustment is equal to 200 for a city with a population of 10,000 or more and an average population density of less than 150 people per square mile, or for cities that are smaller than, with a population of less than 10,000 and an average population density of less than 30 people per square mile. This would affect an estimated 15 cities beginning in 2026. Section 5 is from Senator Hochschild's Senate File 2116, which modifies the calculation of the township aid formula. This creates a town aid factor, which is the product of 3 factors that are currently used to compute the township aid amount, it strikes an obsolete reference to the State Land Management Information Center and inserts a reference to the Minnesota Geospatial Information Office. I will note that this differs from the bill as we heard it in committee. Senator Hochschild's bill also contained an increase in the appropriation for township aid, which is not being carried in the omnibus bill. Sections 6 and 13 are from Senator Rest's mark of the bill, affecting a reduction to the local government aid appropriation. Section 6 reduces the appropriation by $20 million, beginning with aids payable in 2026. And Section 13 contains some changes necessary to implement that reduction for aids payable beginning in 2026, and requires the commissioner to proportionally reduce a city's aid payment so that the sum of all aid payments equals the amount appropriated for aid in 2026. Similarly, Sections 7 and 12 effectuate a reduction in county program aid. This is also from the chair's mark. The reduction in Section 7 is $20 million, beginning with aids payable in 2026. And Section 12 is similar to the local government aid payment adjustment that requires the commissioner to proportionally reduce a county's aid payment so that the sum of all aid payments equals the amount that is appropriated. Section 8 is from Senator Hochschild's Senate File 1089. It increases the appropriation for soil and water conservation district aid to $14.73 million for aids payable in 2025 and 2026, and $14.787 million for aids payable in 2027 and thereafter. Section 9 is from Senator Rarick's Senate File 1028, establishing a aid program for fire protection and emergency medical services special taxing districts. Subdivision 1 defines the commissioner as the commissioner of revenue and defines what special taxing districts are. They are established for the purpose of providing fire or ambulance service or both. Subdivision 2 calculates the distribution as 50% of the district's average certified levies for the previous 5 years, or for the number of years in which the district has had certified levies. The district's annual aid distribution is proportionally reduced if the sum of the calculated aid distributions exceeds the amount appropriated for the aid. So this allows the entirety of the appropriation to be expended. Subdivision 3 requires the commissioner to make the aid payments on July 20th of each year, and Subdivision 4 annually appropriates $1.555 million from the general fund for the aid program. Section 10 imposes a reporting requirement for recipients of public safety aid enacted in the 2023 taxes bill. This is from Senate File 132, which is the early Omnibus bill that Senator Rest authored. It was also included in last year's Omnibus taxes bill. This would require the Commissioner of Public Safety to submit a report by February 15th, 2026 to the chairs and ranking minority members of the committees with jurisdiction over public safety, taxes, and property taxes. Section 11 regards aid penalty forgiveness and contains provisions from 2 bills that were heard by the committee. The first is in Subdivision 1. It's from Senator Gruenhagen's Senate File 1108, providing an aid penalty forgiveness payment to the city of Stuart in the amount of $87,501.50. Subdivision 2 provides an aid penalty forgiveness in the amount of $18,472 to the city of Alpha. This is from Senator Weber's Senate File 2944. Similarly, Subdivision 3 is from that bill and provides an aid penalty forgiveness to the city of Odin for the withheld 2024 local government aid payment and the 2024 small cities assistance payment totaling $39,909. Similarly, Subdivision 4 is from Senator Weber's bill providing an aid penalty forgiveness payment to the city of Trotsky in the amount of $25,003. Subdivision 5 makes an appropriation of the amount necessary from the general fund in fiscal year 2025 for payments to the city of Stuart and the city of Alpha. As I explained when walking through the spreadsheet, no appropriation is necessary to make the aid penalty forgiveness payments to the cities of Odin and Trotsky because that appropriation authority still exists. And lastly, Section 15 is a repealer. This is from the chair's mark. It repeals the sunset of the local homeless prevention aid program, which is currently scheduled, or which currently expires after aids payable in 2028. That concludes the property tax aids article.
Thank you, Mr. Munn. Ms. Pollack, I wonder if instead of going through every single section of Article 6, you could just make a summarizing statement of what the purpose of it here. And I note that there is no one signed up in opposition to it. So if you would just generalize on what what its intention is and so forth, what we've done over the past 2.5 years with regard to this item.
Madam Chair, certainly. Article 5 is the local sales tax reform article, and the language here is largely the same as we heard in committee earlier in the session. And this language, or a version of it, as members know, has been around for 2 sessions now. And the language here reflects some work over the interim by an informal working group convened by Chair Rest and included members of the other body, members of this body interested in the proposal, and also members of interested groups that would be affected by the legislation. Generally, the article provides for local governments to impose a local sales tax without seeking legislative approval if the projects that are as are enumerated here in this article meet certain criteria. And there is also a requirement for a distribution share for local sales taxes that are imposed by cities under certain conditions where there are neighboring cities that are also not imposing a local sales tax. Madam Chair, I'll just note two distinctions here from the language as we heard it in committee earlier this session. The definitions of park and trail have been modified, and they mean parks or trails that meet criteria of regional significance as determined by the Greater Minnesota Regional Parks and Trails Commission. And then, Madam Chair, in the bill, as we heard it in committee, there were some blanks for the percentage cost increase and the amount of time that the tax could be imposed if a political subdivision chose to exercise authority to increase those due to inflation. In the chair's mark here, those amounts are 3% for the project cost and 10 years for the amount of time that the tax may be imposed, although the tax may not be imposed for more than 30 years total. That is all I have to say on this article, Madam Chair, unless you have further questions.
Thank you, Ms. Pollack. Mr. Silvio, Article 6.
Madam Chair, members, Article 6 is the tax increment financing article. It begins on page 20 of the summary. Section 1 is from Senator Rest, Senate File 23. This is on behalf of the Office of the State Auditor, and this relates to clarifications from the 2021 temporary transfer authorization. This section clarifies that increment transferred under that authorization must be spent, loaned, or invested by December 31st, 2025, and further clarifies that the requirements to return increment includes proceeds, principal, and interest earned on loans of transferred increment, interest or investment earnings on transferred increment, or other repayments or returns of transferred increment. Section 2 is from Senator Bass, Senate File 1314, and this would extend the date by which the city must adopt an interfund loan resolution. Section 3 is from Senator Zhang, Senate File 109, concerning the city of Maplewood. This would expand the geographical area in which tax increment may be spent. I will note that the language that appears in Section 3 is not the same language that was heard by the committee a few weeks ago. Within this section, the geographical area in which the increment may be spent has been reduced from how it was originally proposed in the bill. Section 4 is from Senator Limmers, Senate File 65 for the city of Maple Grove. This would provide a 5-year extension and also a duration extension for soil deficiency districts. I will note that due to the duration extension requirements to approve the 5-year rule is by city only. However, the duration extension requires approval by the city, county, and school district as is required under law. Section 5 is from Senator Uma Verbaten's Senate File 2047 that would extend the 5- and 6-year rules for the Ford site redevelopment TIF district in the city of St. Paul. Section 6 is from Senator Weber, Senate File 2337, and this would extend by 2 years the date by which the city of Bloomington must spend, loan, or invest unobligated increment pursuant to that 2021 transfer authorization. I will note that what appears in Section 6 are also 2 additional requirements that were not part of the original proposal, and those are the city is also granted a 2-year extension of the date by which construction must commence from December 31st, 2025 to December 31st, 2027. And there is also a requirement that increment must be spent within the 2 districts noted in the proposal, those being TIF districts number 1C and 1G. Section 7 is from Senator Paz, Senate File 85. And this would authorize the city of Brooklyn Center to establish not more than 2 redevelopment TIF districts within a defined area. Section 8, 9, and 10 are all from Senator Hoffman's Senate File 3009. Members may recall that bill proposed the establishment of 3 different TIF districts with a number of special law requests. I will note that what appears in Section 8, 9, and 10 for each isolated district is only an exemption from the blight test and an exemption from the 90% rule, so that 90% of increment generated from a TIF district does not need to be spent on blight correction. All other special requests that were within the original proposal are not included in these three sections. Section 11 is from Senator Swedzinski, Senate File 115. This would authorize the City of Eden Prairie to establish not more than 2 redevelopment districts within a defined area subject to special rules. Sections 12 and 13 are from Senator Mann, Senate File 1476. These sections provide authorizations to the City of Edina to extend the 5- and 6-year rules for 2 identified TIF districts. Also would authorize the city to approve duration extensions for each of these 2 districts. Again, I will note that the duration extension for each district requires approval by the city, county, and school district. Section 14 is from Senator Dames, Senate File 2463. This would extend from December 31st, 2025 to December 31st, 2027, the date by which the City of Marshall must spend, loan, or invest unobligated increment. This is again related to that 2021 temporary transfer authorization. Section 15 is from Senator Swedzinski's Senate File 736. This would authorize a 5- and 6-year extension of the 5-year rule for the City of Minnetonka. It would also exempt the district from the requirement that 90% of increment generated from the district be spent on blight correction. I will note that during the committee, an amendment was adopted that would provide a 4-year rule extension. That language is not provided here in Section 15. Section 16 is from Senator Kupek, Senate File 1994 for the City of Moorhead, and this would provide a 5- and 6-year rule extension for a district in the City of Moorhead. Section 17 is very similar to Section 14. Section 17 is from Senator Zhang, Senate File 2083. And this would provide a similar 2-year extension for the City of Oakdale, upon which they must spend, loan, or invest unobligated increment pursuant to that 2021 transfer. Section 18 is from Senator Westland, Senate File 63. This would authorize the City of Plymouth to establish not more than 2 redevelopment TIF districts in a defined area subject to special rules. And lastly, Section 19 is from Senator Putnam, Senate File 2860, and this would authorize the City of St. Cloud to establish not more than 2 redevelopment districts. Special rules are also noted within Section 19, and I will note that Sections 18 and 19 are as they appeared in committee without further changes. And that concludes the TIF article, Madam Chair.
Mr. Sylvia, Article 7.
Madam Chair, Article 7 contains the entire public finance bill as proposed by the Minnesota Institute of Public Finance. This was Senator Rest's proposal, Senate File 2880. I will note that the language is carried here in its entirety. There are no changes. I'll just sort of highly summarize the sections. Sections 1, 4, 6, and 9 harmonize the periods in which the notice of bond issuance and the date and time of a public hearing to discuss the bond issuance must be published in an official paper. Section 2 modifies the definition of debt obligation to include the construction of a courthouse or justice center if connected to jail, correctional facility, or other law enforcement facility. Section 3 allows properties and projects in the credit enhancement program to be refinanced at a lower interest rate. Sections 5, 7, and 9 all relate to the Minnesota Bond Allocation Act. Section 5 clarifies that the act applies to bonds issued by economic development authorities. And Section 7 and 8 clarify that for residential rental project and other types of projects, their allocations, the period in which an issuer must permanently issue obligations shall be the earlier of 180 days of the allocation or the last business day of December. And lastly, Section 10 clarifies that counties may authorize bond financing for sheriff's offices, law enforcement centers, or courthouses or justice centers attached to a county jail.
Thank you, Ms. Pollack. Article 8.
Madam Chair, Article 8 is the Sustainable Aviation Fuel article, and it comes from language in the governor's bills and also from your bill, Senate File 1312, Madam Chair. Section 1 modifies the definition of sustainable aviation fuel for purposes of the fuel that would qualify for the credit. I will just note that this definition reflects feedback from members of the relevant industries and the agencies that would be administering the credit. So Section 2 adds a requirement to the processing of sustainable aviation fuel for purposes of credit eligibility and also allows a supplemental tax credit for 0.02 cents per gallon for each additional whole percentage carbon intensity reduction beyond 50% up to 50 cents a gallon. And sections 3 and 4, Madam Chair, are the same as were presented in committee, increasing the allocation limits in fiscal years 26 and 27 from $2.1 to $7.4 million and extending the credit through fiscal year 2035 with allocation limits of $2.1 million for those remaining years. So, as I mentioned, Section 4 is the same as presented in committee, extending the expiration date of the credit to tax years beginning after December 31, 2035. And that concludes Article 8.
Article 9.
Madam Chair, members, Article 9 is the taxation of gas products chapter. This language is identical to the language that the committee heard last week from Senator Hochschild, Senate File 2530. I will just note the only changes that are made here include technical changes recommended by the Department of Revenue. Just as a very high-level overview, this article incorporates the production of gas into relevant statutes, establishes helium relief areas, establishes helium homestead property tax credit, makes certain sales tax exemption changes, provides for a gross proceeds tax rate for certain gas products, contains a distribution of those gross proceeds revenue, and lastly, creates an allocation of occupation tax revenue from the proceeds of gas that are portioned to the general fund from the production of gas products. Unless there's further questions, Madam Chair, I don't know that I have additional comments to make on Article 9.
Sure, that's fine. The next article then, please. Excuse me.
Madam Chair, Article 10 is the miscellaneous article. Sections 1 through 7 modify the Tax Expenditure Review, or TURC, Commission statute. These sections all appeared in your bill, Madam Chair, Senate File 45, and sections 2, 3, and 7 also appeared in Senate File 132. Generally, these sections modify the dates by which meetings must be convened and reports are due, requiring the commissioner to call the first meeting of the year, and replacing the term purpose with objective for purposes of the purpose statement requirement. These sections are effective the day following final enactment. Sections 8, 9, and 11 come from your bill, Madam Chair, Senate File 447, to establish the Consumer Protection Restitution Fund for money recovered from a consumer protection-related action brought by the Attorney General. These sections are effective July 1, 2025. Sections 10, 14, and 15 replace the term notice with the term ruling for purposes of establishing a revenue ruling program in Section 14. These sections are effective July 1, 2025. Section 12 comes from Senate File 1712 from Senator Putnam, increasing the maximum amount of bonds that can be issued by the State Agricultural Society from $30 million to $50 million, effective July 1, 2025. Section 13 modifies the statute authorizing and establishing requirements for the Department of Revenue notices and establishes a revenue ruling program. This section is based in part on Senator Nelson's bill, Senate File 783. It establishes how revenue rulings may be requested and establishes requirement for review and publication of revenue rulings and the effect of revenue rulings. These provisions are effective July 1, and it also requires a report to the legislature due by January 31, 2027. Sections 17, 18, and 19 come from Senate File 219 from Senator Abler, amending the definition of an eligible individual for purposes of the e-bike credit. These provisions were heard in the amendment we heard in committee recently, Madam Chair, and I believe they also appear in the Omnibus Transportation Bill. These sections also establish income thresholds and new requirements for how rebate certificates are issued, and these are effective for tax year 2025. Sections 20 and 21 come from the Senator Rest bill here, Senate File 2374, and also appear in the governor's bill pertaining to penalties relating to property tax refunds and certificates of rent paid for purposes of failing to provide a certificate of rent paid to a renter and failing to provide a certificate of rent paid for a manufactured home park owner. Sections 22 and 29 come from the chair's mark here. They reduce the annual per acre SFIA payment by 10% and allow claimants with lands enrolled in the program to withdraw the land without penalty and be released from their covenant. Section 2374 also is in the governor's bill, requiring the commissioner to deposit revenues from the cannabis gross receipts tax to the general fund and removing the local cannabis aid account in the special revenue fund. Section 24 comes from the chair's mark here, adding the Office of the Legislative Auditor to the definition of requesting agency for purposes of agencies that are allowed to access federal tax information held by the Department of Revenue. Section 25 comes from Senate File 209, Senator Umar Baton, striking the reference to the illegal cannabis and controlled substance chapter from the definition of criminal act. Section 26 cancels any balance in the local government cannabis aid account on January 2026 and directs it to the general fund. This provision is also in the governor's bill. As is Section 27, canceling any money in the tax filing modernization account created in the 2023 Omnibus bill to the general fund. It also cancels the $10 million appropriation from the general fund for a grant to the city of Minneapolis. These are effective the day following final enactment. Section 28 pertains to the revenue ruling program established earlier in the bill and provides that it specifies the effect of revenue notices issued on or before July 1, 2025, and the commissioner's requirement to publish a revenue ruling if a revenue notice is modified after June 30th, 2025. Section 29 comes from Senate File 199, Senator Klein's bill to make a one-time appropriation of $250,000 in fiscal 25 for a grant to the city of St. Paul for planning and development costs. Section 30 comes from the governor's bill to provide an appropriation to the Department of Revenue for a pass-through audit unit in fiscal years 2026 and 27. Section 31 appropriates cancels any amount remaining of the $4 million appropriation for the e-bike program and appropriates that amount to the Commissioner of Transportation for local business construction impact assistance program. This section would be effective upon enactment of that program or similarly styled legislation in this session or a special session this year or next year. Section 32 requires a report on the e-bike rebate program. This was also included in Senate File 219 from Senator Abler that we heard and is also included in the Omnibus Transportation Bill. The next several sections require studies for various provisions that we've considered in the committee. Section 33 requires the Commissioner of Revenue to consult with representatives of professional sports teams and members of legislative committees with jurisdiction over taxes to study and provide recommendations regarding the accrual method of remittances of sales taxes for the sale of privilege of admission to professional athletic events. Section 34 requires members of legislative committees with jurisdiction over taxes and higher education and policy to consult with various parties regarding funding the state grant program. Section 35 requires the commissioner in consultation with other entities to review and evaluate the Hennepin County baseball stadium tax to determine whether the tax should be extended and whether it should fund purposes other than currently authorized purposes. Section 36 requires the mayor of the city of St. Paul, in consultation with other specified entities, to provide recommendations regarding modifications to the St. Paul local sales tax first enacted in 1993. Section 37 requires a study on a study and recommendations and a report on the legalization of sports betting, fantasy sports, or both. Section 38 requires a study and evaluation and recommendations on options for funding capital improvements to the U.S. Bank Stadium. Section 40 repeals the local government cannabis aid account, also repeals the tax modernization account, and repeals data practices provisions pertaining to the marijuana and controlled substances tax. Those provisions were repealed in earlier articles in the bill. Madam Chair, that concludes Article 10, and I just have a comment about the remaining articles, if you would allow.
Yeah, we're not going to go in. The three remaining articles are the Department of Revenue's technical and policy bill. If you can be very short, we're not going to go back through them section by
Madam
section.
Chair, Articles 11, 12, and 13 are the department's policy and technical articles, Senate File 2997. These are the same as presented in committee, except for a section removed from Article 13, repealing a cash reporting requirement for lawful gambling organizations. Madam Chair, that concludes the delete everything amendment.
Thank you very much, the three of you. We appreciate your work. We're going to move to testimony now, and beginning with the Commissioner of Revenue. This time of year, there are any number of rallies and meetings going on right above this room around the seal, and it can be distracting. I choose for it not to be distracting. Commissioner Marquardt.
Thank you very much, Madam Chair and members of the committee. Thank you. I am, for the record, Paul Marquardt, the Commissioner, Department of Revenue, and thank you for allowing me on behalf of the governor to testify on Senate File 2374 as amended. Madam Chair and members of the committee, you have produced a good bill that will go a long ways in helping to solve the ongoing structural budget deficit and also helping Minnesotans at the same time. And I also want to thank the chair and members of the committee for hearing the governor's tax bill, I think not once but twice, actually. So really appreciate that, and for including many provisions that was in the governor's tax bill that is in this one. And certainly that sustainable aviation fuel is a big one that's going to benefit the environment and the economy. And just really commend the committee for getting that through. Also includes the short line railroad credit transfer, the repeal of the K through 12 credit assignment piece that was also in the governor's bill. The additional penalty on the certificate of rent paid will help renters who are filing that credit. And Madam Chair, I know you and members of the committee were big advocates back in 23, and actually before that, is moving the renter's refund to the renter's credit. And one of the big reasons was that it would increase the number of people taking the renter's credit. And in fact, that's what we're seeing right now. So last year, when it was the refund, it was 323,000 renters took the credit. This year, as of April 15th, and there will be more, it's 354,000. That's a 10% increase. So that is bearing fruit on what we talked about a couple years ago. The attachments and appurtenances, and that's all I'm going to say about it. Hopefully we can get that through this time around. Thank you for including the revenue's ability to enhance its audits of kind of complicated partnerships and so forth. The personal property tax exemption for low-income housing tenants is very important, and also for including the department's policy and technical bill. That is greatly appreciated. So just finally, again, just a huge thank you for the great and strong partnership with the Department of Revenue, but with this committee and the time you've afforded me and the governor to propose and talk about our bills. And we stand ready and to do whatever as we move the bill forward in the conference committee to get a bill that benefits Minnesotans. So, Madam Chair and members, thank you so much.
Thank you very much, Commissioner Marquardt. Next, we have, with regard to Article 1, starting with Hannah Alstead. It's the limit. The limit is 2 minutes, and we have a timer.
Okay. Thank you. Good morning, Madam Chair and members of the committee. My name is Hannah Alstead, and I'm the political director for the Teamsters Joint Council 32, representing 80,000 active and retired union members in Minnesota, North Dakota, South Dakota, Iowa, and Wisconsin. Thank you for the opportunity to speak with you today about the Teamsters' deep opposition to cutting the film tax incentive in Minnesota. In 2019, film and TV projects that went through the state's rebate program made for a total spend of $7.6 million. In 2022, that number was $20.8 million. That was due in part to the creation of the state tax credit. This was great progress, and in 2023, we fought to increase the amount of the credit to $25 million. Unfortunately, this continued growth of the industry here in Minnesota was slowed by a 6-month-long strike in the industry and devastating fires in Los Angeles that brought the industry to a standstill. But Minnesota is on the verge of taking off. We have producers, who you'll hear from today, coming to Minnesota right now looking to source significant films and TV shows here. We're just getting the industry stood up, and cutting the tax credit now will rob our state of a real opportunity to create jobs in this exciting industry. The Teamsters Motion Picture Division consists of 15,000 members in 74 local unions across the country. These members work as drivers, location professionals, casting directors and associates, animal trainers, handlers and wranglers, dispatchers, DOT admins, mechanics, chef drivers, chef assistants, and more that support the production of feature films and television. If this drastic cut takes effect, it will be a tremendous disservice to the people in and out of this room who have taken part in the 15-year fight to get this tax credit in place. If we cut this credit, we will continue to lose productions, episodic projects, and stable union jobs to other states that offer more competitive programs. Please oppose any and all cuts to the Minnesota Film Credit.
Thank you. Mr. Zellers and Mr. Cook, if you would come forward.
Good morning, Madam Chair,
Welcome
members of the
to
Tax
the
Committee.
committee.
Kurt Zellers, CEO for the Minnesota Business Partnership, and I'm here on behalf of the 500,000 Minnesotans and 4.8 million employees globally that work for our MBP member companies. And I want to thank Madam Chair for the Sustainable Aviation Fuel credit included.
You're to speak in opposition today.
No, I'm in favor of that one, Madam Chair.
No. The only thing we want to hear is what you oppose.
Okay. Well, I just wanted to give you credit for one good one.
Thank you.
And for the AC/DC concert upstairs. Very impressive. Madam Chair, and not a surprise, we were in strong support and would ask for inclusion as you get into the conference committee of the 25% refundability on the R&D tax credit. As you probably know, and many of the committee members, Minnesota was the first in 1981 to include an R&D tax credit Unfortunately, our neighbors have found our good idea and have now moved it even further along. Wisconsin has a 25% refundability. Iowa is unlimited. And then other pro-business states that are much more aggressive in their pursuit of Minnesota companies. In Wisconsin, or excuse me, in Texas at 25%. Georgia's up to 50%, and Arizona, of all places, at 75%. So our advocacy is to not only maintain that legacy of research and development as a motivator here in Minnesota, but to catch up to our neighboring states, and then, again, make sure that we are Minnesota competitive going forward. The last thing I would say in the investment credit, Madam Chair, going from 0.5 to 1% again is a little bit of an increase, and that is going to affect some of our members, but also some Minnesotans that we want to keep here, those high-income earners who will participate in charities, participate in a number of different events around Minnesota that are beneficial because they're here and they donate their time and their treasure. So thank you, Madam Chair. We look forward to working with you in the coming conference committee.
Thank you very much. Mr. Cook. And I'll also ask Mandy Turpin, Van Hayden, and Ricky McManus to, if you're here, if you would take a chair at the witness table. Mr. Cook.
Great. Chair Rest, members of the Taxes Committee, my name is Brian Cook. I'm the Director of Tax, Fiscal Policy, and Elections for the Minnesota Chamber of Commerce. As you know, the Chamber represents more than 6,300 businesses of all sizes throughout all corners of the state of Minnesota who employ more than 500,000 employees. This morning, I would like to share our opposition to several provisions proposed in Article 1 of the A4 Amendment to Senate File 2374. First, we oppose increasing the net investment income tax from 1% to 1.5%. The Chamber opposed the creation of this tax 2 years ago and increasing it now on top of Minnesota's 9.85% top personal income tax rate, which is the 6th highest rate in the nation, further widens the state's competitiveness gap with neighboring and peer states. Increasing the burden on some of the most mobile earners and investors risks encouraging them to relocate by raising their taxes by approximately $145 million over the next 4 years. We also oppose the proposed reduction for the net operating loss deduction, or NOL. 2 years ago, the legislature decoupled from the federal government and brought the maximum deduction down from 80% of taxable net income to 70%. Reducing it further to 60% will increase business taxes by around $92 million over the next 4 years. Startups who may take years to become profitable and businesses in cyclical or volatile sectors rely on the NOL deduction to manage financial risk and reinvest from year to year. This reduction would create added economic strain for those businesses and could hinder their growth. Minnesota already ranks 32nd nationally in new business creation, but we lead the country in 5-year survival rates. That's something to be proud of and something worth protecting. Further limiting the NOL deduction threatens that strength and could stifle the business innovation that is so vital to our state's economic health. There are additional provisions that we oppose, such as the Section 530 nonconformity, also in Article 1, and a few that we support, but in the interest of time, I'll direct your attention to the letter we've submitted in your packets. In closing, we urge the committee to reconsider the provisions that would harm Minnesota's tax and business climate. As this legislative session nears its end, well, hopefully nears its end, the Chamber stands ready to help you advance policies that strengthen the long-term economic vitality of our state. Thank you.
Thank you. Mandy Turpin.
Thank you, Madam Chair and members of the committee. First, I'm honored to be able to give them this opportunity to speak today, but I'm even more proud to see so many of my fellow filmmakers in the room. As you will see, this is a community of hardworking, passionate people that believe in Minnesota. My name is Mandy June Turpin. I'm a producer. I have been in the entertainment industry for more than 25 years. I have worked in front of the camera and behind the camera, and recently I started a business in Minnesota with my partner, Carl Gadjusek. I have produced 4 features in the last 3.5 years in Minnesota. That's $9 million in money that has directly gone into the state. For every dollar the state has given me in tax credits, I have spent $6.9 on businesses, hotels, car rentals, crew, etc. We are an industry that supports small business. We are a business of tradesmen. I have never once asked anybody for their high school diploma or their college transcript. We believe in opportunity for everybody. Just this month, California raised their tax credits to $750 million a year because they understand the opportunities and the importance of keeping jobs in the state. I bought a house in Minnesota. I chose to move my family from LA, where I had a successful career, to Minnesota because I believe in the state and these people. Let me be clear, a $1 million tax credit will not sustain this industry. Minnesota will lose. You will lose on tax money, you will lose on businesses, but more important, you'll lose the amazing individuals who are in this industry to other states who are more competitive. We have productions in prep, not to mention a $25 million movie and a TV show that I am bringing here with my producing partner. Minnesota deserves the opportunity to show how special it is. I have worked all over the country and all over the world for that matter, and this is one of the best places I've ever worked, and especially with these people behind me. I hope you will consider not getting rid of the tax credit. Thank you.
Mr. Van Hayden.
Hi, my name is Van Hayden. I'm the former co-chair of the Minnesota Film and Television Board. I'm the former past president of the Minnesota Film Alliance. And for the past 35 years, I've worked in this industry. I had to leave Minnesota to work for the most part. And in full disclosure, I am the cousin of your former Senate colleague, Senator Jeff Hayden, former deputy leader. But I'm here, I guess, to ask why we're here and answer some of those questions. We're here today because, you know, what we do is we show up as craftspeople, and we come and we try to learn our craft and hone our craft and excel in our craft so that one day, if everything goes right, we attain the skills to produce the edifices necessary to construct the best product we possibly can. And whether that product is in the form of a motion picture, a beloved television series, or a memorable commercial spot, you know, what we do is we combine our efforts to do the best we can, and we want to do that here. And we support the incentives that you guys have provided in the past, and we want to continue those. We do this with pride, we do it with dignity, and we do it with passion. You know, our carpenters that build the world-class sets, our scenic artists that paint the sets, our set decorators that dress those sets and provide the platform for the actors who deliver their inspiring performances after being written and captured by our camera operators, our sound recordists, and their equipment that's been delivered expertly and safely to the locations that have been secured by professional location managers, to the stages and the places we work. So I rise in opposition to making the cuts. Thank you so much for the consideration. We really appreciate it.
Thank you very much, Mr. Hayden. Ricky McManus, welcome to the committee.
Thank you, Madam Chair and committee members. My name is Ricky McManus, and I'm the Chief Production Officer at the Upper Midwest Film Office, also known as UMFO. I've worked in the industry my entire life, really. My first project was a casting director for Purple Rain, so I've been around. I've seen transformational change happen in the last 4 years because of the state tax credit. The existence of a state film office and a strong tax credit program are table stakes for the industry to exist in Minnesota. Without it, there could never be regular production anywhere in the state. Over the last 4 years, the program made it possible for projects to happen outside of the metro in rural northern Minnesota and Duluth. Since 2021, St. Louis County, Iron Range Resource and Rehabilitation, the Blandin Foundation, and the City of Duluth has collectively invested over $5 million to help northern Minnesota create infrastructure, build crews, and attract projects. By the end of 2025, UMFO will have ushered in 45 projects, and we are currently trying to attract the largest project in Minnesota history. $11.5 million in local direct spending, and it's actually projected to be more than that. More than 38 workforce development workshops has really created a workforce pool now being used in the industry. Job creation in rural Minnesota helps to shepherd in a new economy. You know, we have a filmmaker that came to Chisholm, Minnesota. He'd never been to Minnesota. He's from LA, and he said, wow, I like Chisholm. He bought the bakery. You know what else he did? He put together an Airbnb. Then he just opened another bakery in Hibbing. This is what we love to see. He's really helping to revitalize Chisholm, Minnesota. Thank you so much, and I'm asking for your support to help us keep this momentum going.
Thank you, Ms. McManus. Mr. Mike Hanley.
Madam
Welcome to the
Chairman,
committee.
members of the committee, I wish I could be as
Mr.
eloquent
Hanley,
as.
you need to state your name.
Oh,
for
I'm
the
sorry.
record.
My name is Michael Handley. I'm a union member, and I own a business here in Minneapolis. I've worked in the film industry since 1991. Since we started out with, we had a lot of incentives. We had a lot of other films and stuff back then. I'm sure you've heard all those stories before. Graffiti Bridge, Grumpy Old Men, all those things. A lot of the guys my age have been trained on those features. We went on and we did a lot of other commercial work. We worked for, Best Buy, Target, 3M, Cargill, Toro, all these companies here that needed media help, that needed workers to be able to film, light, do hair and makeup, build sets, things like that. All these people that are here are all independent workers. We've all lived based on our last job. So it's kind of like an election year for us, every job we're at. Every time we work, we don't, we're not necessarily scheduled out for another 2 months. So the film incentive would help stabilize a lot of that for us. It would help us grow the business, have more stability. I think that, sorry, those are disgruntled actors. We told them they couldn't work here in Minnesota. We said they couldn't work here in Minnesota, they'd have to move to LA, and they're upset about it, At any rate, we're the workforce for Minnesota film, television production. We bleed out into all these other industries that are local here. We help make photographs, we help make videos, pictures, all those things. The training ground for all of us has typically been feature films, because you can walk on a set, like my daughter's here. She started 2-3 years ago. Thank you for your time.
Sure. Thank you, Mr. Hanley. We'll move on to Article 3, Tyler Dyers.
Good morning, Chair Rust, members of the committee. My name is Tyler Dyers. I serve as the Midwest Executive Director for TechNet. We are a technology trade association representing 100 innovative member companies. I'm here this morning in opposition to the new tax on social media platforms. I'll keep my testimony brief, but I did submit a written letter for more information on our position. Respectfully, TechNet is opposed to this bill as we believe it violates the Federal Internet Tax Freedom Act because it applies only to internet-based platforms, yet offline entities that collect same consumer data or operate similar businesses are not subject to the new tax. Under the Internet Tax Freedom Act, this would create a discriminate and disparate tax burden on electronic commerce, which would be in violation of that federal law. As a result, the state will likely have to spend valuable resources in defending this new tax in court in what could be a lengthy litigation process and may not produce needed funds for the state. We understand that this may be appealing because many of the 14 businesses who would pay this new tax are based outside of the state of Minnesota. However, the burden of the tax could be passed along to Minnesotans in the form of increased cost of digital advertising in the state if it did survive a legal challenge. Businesses that utilize advertising services through these platforms in the state would ultimately be the ones who absorb the costs, who in turn pass it on to their consumers. We also have concerns with how this bill would be operationalized. In order to be compliant with the law, companies would need to collect more data, not less. And it is also unclear how a company could verify location if a Minnesota resident were to exercise their rights under the Minnesota Consumer Data Privacy Act, which is a landmark data privacy law that was passed here last year and goes into effect July 1st. For these reasons and those outlined in our letter, we ask you not to move forward with this provision. Thank you, Madam Chair, again, for your indulgence, and I'd be happy to answer any questions.
Thank you very much. Article 4, Patricia Nauman. And Bradley Peterson. Ms. Nauman.
Thank you, Madam Chair and
I'll
members.
also ask Katie Topinka to come forward, too, if she's present. Ms. Nauman, sorry.
No, that's all right. Thank you, Madam Chair and members. My name is Patricia Nauman, and I'm the Executive Director of Metro Cities, representing cities across the 7-county metropolitan area. I'm happy to have the opportunity to comment today on Senate File 2374, specifically the provision and the reduction to local government aid contained in Article 4 of the bill. Metro Cities would respectfully oppose the reduction in local government aid for cities contained in this bill. We do understand the budget challenges that the state is facing, certainly, and are appreciative of those circumstances. Metro Cities also does recognize the importance and a need for a strong fiscal partnership between the state and its local units of government. Local government aid is a key component and underpinning of a strong state and local fiscal relationship, and stability and adequacy in the appropriation of local government aid is vital to ensuring that cities can meet the infrastructure and service needs that they are responsible both for providing locally and as well from state mandates. Cities are facing myriad challenges right now. I think we're all aware of all the challenges all units of government are facing. Some of those challenges are the increasing costs of infrastructure and services, and the increasing need for higher levels of services to meet growing populations and changing needs of those populations. Cities are also facing increased needs for personnel at a time of shortages, and that does increase costs. They also are facing a lot of federal funding uncertainties, as we know that the state is as well. We would ask that you keep these factors in mind as you continue to work on a tax bill and to balance the state budget, and we look forward to continuing to work with you in that process.
Thank you, Ms. Nauman. Mr. Peterson.
Thank you, Madam Chair and members. My name is Bradley Peterson, here today on behalf of the Coalition of Greater Minnesota Cities, and here to discuss our opposition to the LGA cuts contained in Article 4 of this bill. I want to start by acknowledging the fact that this committee had a very, very tough target. You had a tough job here. Nonetheless, as we've discussed many, many times, LGA helps equalize tax-based disparities across the state and helps cities provide quality public services. Greater Minnesota communities are especially vulnerable when it comes to cuts to LGA. Greater Minnesota cities receive 67% of the total LGA appropriation because we only have 27% of the state's total tax base. If you look at the cuts on a per capita basis, they amount to $2 per capita in the metro and $5 per capita in Greater Minnesota. In terms of LGA's relation to the overall state budget, a couple of points. LGA as a share of the state budget has been shrinking over time. Despite significant increases in the cost of delivering local services, LGA has not kept pace with inflation. Unlike other expenditures in the tax area, the LGA appropriation is fixed in statute. For instance, the sales and use tax exemption on data centers has grown to over $100 million and will continue to grow. LGA is fixed in statute from now until forever unless the legislature actually changes it. We also believe it is unfair that LGA is slated for reduction while the Homestead Credit Refund Program, which primarily benefits the metro area and has grown substantially over time without restraint, is held harmless. Before we ask our local governments and their residents and businesses to settle for less in services while paying higher property taxes, we would urge the legislature to take a hard look at those expenditures in our tax code that are growing unrestrained before we ask our Greater Minnesota communities to settle for unnecessary austerity. Finally, it is difficult to understand the necessity of an LGA cut in the context of this bill. As I understand it, this bill raises $316 million in new revenue in the next biennium, yet somehow an LGA cut is still deemed necessary. The bill allocates several million dollars to other things such as sporting tickets. In conclusion, any cut to LGA is unnecessary and unfair. Thank you.
Thank you very much, Mr. Peterson. And I will ask Beth Johnston and Mike Slavic to come forward. Mr. Pinko.
Thank you, Madam Chair. My name is Katie Topinka. I'm the Director of Intergovernmental Relations for the City of Minneapolis. We appreciate the opportunity to comment on the Senate taxes proposal. We know you had a difficult task to put together a tax bill with a negative target and appreciate that you have to make tough choices when constructing your bill. There are several provisions we do have concerns with. We'll follow up with more detail on some of those in writing, but wanted to emphasize our concern about the proposed cut to local government aid. Minneapolis uses its LGA to support city operations, and it directly offsets the burden on the property tax levy. A reduction in LGA directly impacts the city's property taxpayers. The cut to LGA is especially concerning at a time when commercial and industrial property values are down. Minneapolis Mayor Jacob Fry was here before this committee earlier during the session to support the CUB credit, where he illustrated the short-term challenges we are facing as we try to reimagine downtown Minneapolis for the future. From 2024 to 2025, the estimated market value of downtown commercial properties decreased by 9.5%, and we anticipate further declines in values as the commercial market continues to right-size itself post-pandemic. A reduction in LGA further exacerbates the property tax burden shift from CNI to residential properties, hurting low to moderate income, particularly fixed income homeowners the most. We are also concerned about cuts to county program aid and the repeal of the local cannabis aid. Local governments are dealing with tremendous uncertainty and limited tools available to address it. The partnership between the state of Minnesota and local governments is critical to maintaining stability for our residents, and we look forward to working with all of you to find ways to minimize these reductions as the bill moves forward into conference committee. Thank you again for the opportunity to testify.
Ms. Johnston.
Chair Rest and members of the committee, for the record, my name is Beth Johnston, and I'm with the League of Minnesota Cities, here representing our 842 member cities. I join my fellow city colleagues in sharing our concern with the $20 million reduction in LGA. We understand that there is a lot of effort that goes into creating this tax bill, and it is not easy, and we appreciate the time and thoughtfulness that Chair Rest that you've had throughout session. LGA is not free money. It's distributed on a formula that measures a city's need and compares it to its ability to pay through its local tax base. It aims to make sure that cities are able to provide a basic level quality of services regardless of their ability to generate tax revenue. It's also the fundamental partnership, or tenet of the state and local fiscal partnership. It does not grow based on rising costs and inflation, as some of my colleagues mentioned. Cities rely on our state to adjust this and adjust the formula and increase the expenditure to ensure the fiscal relationship between the state and local governments remains healthy. However, over time, LGA's ability to buy has decreased as the appropriation remains flat or is reduced. Its high point was over 2 decades ago in 2002. And if then the appropriation had been adjusted to inflation, we'd be over $1 million today. LGA provides property tax relief on the front end, and on average, a city receiving LGA would have to increase its property tax levy by more than 60% to provide the same level of services without it. It also has a proven track record of growing, helping slow the growth of city levies, and when it's reduced, cities also must reduce their appropriations for police, fire, and other critical services or raise their own revenue by putting more pressure on local property tax bases. Cities like the state are facing increased costs to provide services, and while we are sympathetic to the committee's budget target and the future pressures on the state finances, we respectfully request that the committee does not reduce LGA or cut the local cannabis aid that will further strain the city's services. Thank you.
Mr. Slavic?
Good morning, Madam Chair and members.
Commissioner Slavic.
Thank you. Good morning, Madam Chair and members. My name is Mike Slavic. I am a Dakota County Commissioner and President of the Association of Minnesota Counties, representing all 87 of Minnesota's counties. Well, there are many things I would like to talk about and provide input on this tax bill. That I'm going to focus on county program aid. In short, these cuts are devastating to an already devastated layer of local government. Counties are extremely concerned, and that is to put it lightly. Counties are facing a property tax catastrophe by this legislature that could result in the largest levy increases in some counties' history. We know that counties are an invisible layer of government and that are often forgotten. We also know that members place a high value in the confidence in us to get the job done and find a way. But we're telling you that is not possible without real, significant property tax pain. County work is often invisible, except for the valuable people that the vulnerable people that we serve. We are the sole and functioning apparatus of Minnesota's social safety net, taking care of our disability community, our veterans, our juveniles who may be involved in the justice system without families or have high acuity needs, our seniors without care options, and hundreds of thousands of Minnesotans signing up for food assistance, rental and housing programs, medical assistance, or other general welfare. These functions are in addition to what we do like transportation, waste infrastructure, and elections. While the state has not fully accounted for the costs of these mandates, not even close, they do try to give us some support through general purpose county program aid. Our CPA-LGA relationship has never been fair, receiving sometimes half or a third what cities get with far less mandates. Please do not go and put us backwards after the great success we've had in recent years. Counties are facing hundreds of millions of dollars. I repeat, hundreds of millions of dollars in proposed HHS cuts in areas of the Senate budget, including what you will be voting on and talking about today on the Senate floor. While the proposed $20 million in CPA cut decrease in this bill may not seem like much, it is certainly a much for us when it comes to shifts. We thank you very much for your consideration.
Thank you. Commissioner Bigham.
Thank you, Madam Chair. And members, my name is Carla Bigham. I'm a Washington County Commissioner and member of the Minnesota Intercounty Association. There are multiple items in this bill that impact counties, but I came here to talk about the proposed cuts to county program aid. CPA goes to every part of the state. All 87 counties receive it. It is direct property tax relief that provides funding for essential services for residents across this great state. The proposal to cut county program aid on top of the over $100 million in cost shifts onto counties from the other committees will drive up property taxes. That is undeniable. The last time cuts to county program aid became law, property taxes increased at a level we hadn't seen since 2011. And if cuts proposed in this bill become law, and on top of the cost shifts, we will see property taxes increase even more this time. Given the rising costs and other state mandates, there's already a lot of pressure on property taxes. When costs get shifted onto counties, it's the property taxes that go up. The Senate proposal includes a 6% statewide average cut to county program aid. County program aid doesn't currently cover the full cost of state mandated spending for counties. Maybe you've heard me say that a few times up here. And the reality is that that hasn't kept up with inflation. It hasn't kept up with the level of commitment Minnesota is used to show the state and local partnership. This bill is proposing to go backwards in a way that we haven't seen in over 15 years. The gains we have made to help with the cost of unfunded mandates and recent budgets would be gone, and that includes the innovative cannabis funding as well. Beyond just the dollar amount of the $20 million cut, these reductions send a message to local governments that we are on our own, that the state does not believe in the partnership with counties, and it does not have to be this way. We understand the state is facing a budget deficit, and we didn't come here to ask for an increase. We didn't expect one. Thank you.
Thank you. Thank you.
I know Chair rest. When my time's done, it's done.
Thank you, Commissioner Bigham. We're going to conclude in just a moment, but tomorrow, just want to let you know that we are going to be taking amendments, and there will be discussion among the members. And I want to alert the members to the other documents that are in your folders for your review. The CPA cuts, the LGA cuts. There's a run for the cities and the counties in that regard. Also, the seasonal tax base replacement aid that is reflected in the DE amendment. That is going to benefit Greater Minnesota school districts for the most part, and I hope that you will review that. But I want to talk just a moment before we end of what we're reacting to here and what we see as a promise of the future. Minnesotans have been talking to us for most recently for the last several months, and we've been responding to them. Bills being brought by Republicans, bills being brought by Democrats, and those responses are in this bill. One of the challenges that we have is to get our heads out of the sand and embrace our modern economy, and this bill does that. We have been listening to business owners, to farmers, to parents, to veterans, teachers, students, renters, and families. We have a goal in this legislature, and this is that, I believe, of Republicans and Democrats alike, that one of our jobs, and maybe our most important job, is to take care of the poor and the sick and children. To do that, we are looking for activities and proposals that embrace a modern economy, the one we're in right now, not the future economy, the one we are in right this minute. And how have we done that in this bill? First of all, the social media platforms tax. Social media companies have been taking the data of Minnesotans and selling it, making billions of dollars from it. And they have not participated in our economy otherwise, other than to make billions of dollars. Not one single Minnesota individual will pay a dime with regard to the social media tax. And as to the impact of on small businesses, what the gentleman did not refer to is how advertising is priced from the social media companies. Google it. See how Meta does it. It is done by either his instant auctions, an auction, not by some top-down pricing of advertising. Certainly, there is revenue increased in this bill, and it is put on the wealthy individuals as well as large corporations, and we do that by looking at the NOL, net operating loss deductions, and by net investment tax, income tax. But what we have not done is put that burden or that contribution on Minnesota's farmers, who routinely engage in their trade and business with capital gains. We continue to lift children out of poverty. There is not one dime that is being taken away by the hundreds of thousands of children who are benefiting right now with the largest and strongest child tax credit in the country. And we are paying attention to those who are being defrauded individually by scams. And we are providing restitution to them as individuals by the fines that are paid by the scammers. And we have looked at the plight of low-income tenants, whether it is with the renter's credit and also with the renter's refund at this point, and also by those individuals that would have had to pay a personal property tax. The governor had it right. He acknowledged that we are in a modern economy and that we should have a modern tax policy. a modern tax policy. That is taking a regressive tax like the sales tax, broadening the base and lowering the rate. That has been across the board, that modernization by people who have, and professionals who have their heads in the sand, not wanting to acknowledge the modernization of our economy. The economy is there, but not tax policy. And this bill doesn't get to that sales tax broadening and lowering the rate, but it does embrace the social media tax. What we have also done is to understand the challenges that are facing Greater Minnesota. And yes, there are cuts to LGA, there are cuts to CPA. Do we regret them? Yes. But everybody at every level of government is going to be participating in the challenges that we are facing right now. And so what have we done? We have expanded the agricultural homestead credit eligibility. We've reduced property taxes for small resort owners. We have lifted the cap on the eligibility and eliminated the cap for the beginning farmer credit. We have eliminated limitations on Minnesota border cities. We have maintained the stability of the soil and water conservation districts. We have dealt with LGA sparsity, penalty forgiveness for any number of small Minnesota cities. We have continued the protection for Minnesota lakes and rivers by not cutting the aquatic invasive species aid. We have increased the number of persons who can participate in the ag homestead classifications from 12 as it is currently in Senator Anderson's bill to 18. We have taken up a very, very moving testimony of a constituent of Senator Rasmussen of the location requirement for qualifying for ag homesteads, and that is a modernization. 40 years ago, it might have taken 40 minutes to get from one county to another to farm your homestead. It doesn't take that long anymore, and it is wrong, the gentleman argued, to assume that modern agriculture is the same as it was 40, 50 years ago. We have allowed a tax exemption in Greater Minnesota for properties that are used by nonprofits for grazing. We have modified township aid formula. We have allowed a loan forgiveness for students who are of critical access dental programs. We have granted an exemption for airport hangars that are used for manufacturing. We have expanded the ag property classification for market farming and also included floriculture. We have also, for Southeast Minnesota, adopted a water quality credit in the karst region. And with regard to taxpayer protection, we have lowered property taxes for disabled veterans, the first time we have done that in years. We have, as I mentioned before, there is no income tax increase for capital gains for farmers. We have also helped Minnesotans who serve in the National Guard, protecting our country, who just happen to serve, to be in Minnesota residents who are in the National Guards of neighboring states. We have also for as taxpayer protection and opportunities. We have become modern in that. We have resisted for years the ability of taxpayers to request a private letter routing. That is now going to be part of the Senate tax bill. We have also used this bill to support education. We are providing for special education teachers who want to get Minnesota certification to participate in the teacher education credit. We have also paid attention to the competition that public colleges and universities have in Minnesota, particularly in the Big Ten, where 10 out of the 18 universities do not have to remit sales taxes on their tickets. We are making that a level playing field for the University of Minnesota. We also have expanded the credit, and this is also for the benefit of Greater Minnesota, especially expanded the credit for CTE training, career and technical education, by supporting those families so that there are students in those schools that do not have industrial education programs but need to get to other sites in order to get that training. And we are making those costs for those families eligible for that credit. In terms of property tax relief, and again, the focus is on Greater Minnesota. We have reduced the property taxes for small resort owners. We have granted additional aid, and we have that run here for rural schools in areas with high numbers of cabin owners. We have paid attention to the requests that come from Minnesota's Native American tribes. We have bolstered fire protection and EMS aid through the proposal that we got from Senator Rarick. And we've also provided for a property tax abatement for economic development that probably will be felt all over the state, not just in the metropolitan area. We have indeed extended the tax benefits for data centers. We have not made it an upfront exemption, but we have extended that date to 2062. We have had a proposal from Senator Housechild for the future of mining, of the future economy. We've done it through tax policy, by incentives with the strategic aviation fuel credit, which benefits in the future the Minnesota farmers as well as investors and the climate, quite frankly. And we have done that by anticipating the operationalizing the discovery of helium, a new way, a new mining, a future mining activity for Minnesota. And yes, we have invested in the world of sport. There is an exemption for PGA sales tax that in the bill, and there are placeholder provisions in the bill for looking at the way in which the world of sport contributes not just to the economic development of our state, but for those major sports that have venues in Minneapolis and in St. Paul, that they contribute by Minnesotans, by the thousands coming into our town areas. They contribute to the safety of Minnesota and the economic benefits and attracting tourists and others from other states that to to participate in that world. So that's where our thinking was coming from. Embracing a modern economy, not the economy of 1950, not the economy of even the year 2000, but the economy that is facing us right now. And here, at least, is a set of responses. And they, I hope, will be well received. But we are going to have an honest discussion about what it means to be in the Minnesota economy vis-a-vis the federal economy in 2025. Committee stands adjourned.